Okay, so let's continue with the GDF session, and we called it "The Asset Managers Are Coming." And I think that the reason we call "The Asset Managers Are Coming" is this group has been working for 2 years on creating this kind of global market of digital securities with assets on one side and destinations on the other side to be distributed, primary, secondary. And we've heard before in this session from Apex, from Provenance, from LRC Group, and we have here a group of additional asset managers. Then we're going to go through and hear from you what you are planning to bring to market in terms of tokenization. Why? What is the reason? What are the business reasons for actually tokenizing, and why you made the decision to tokenize what you're going to tokenize? And we'll talk about the when as well. What is the process we see coming in front of us? But let's start with the introduction. So let's go ahead.
Okay. I'm Russell Barlow. I head the Alternatives Division at ABRDN Asset Management.
Welcome.
I'm Benjamin Dean. I'm Director for Digital Assets at Wisdomtree.
Hi, I'm Victor, heading a digital asset strategy for Hamilton Lane.
Yeah, and hi, David Reed from sort of coordinating our digital assets activity at Invesco.
Okay, so we have ABRDN, Wisdomtree, Invesco, Hamilton Lane, four very, well-respected asset managers, and you're all coming to the world of tokenization at about the same time. So why don't I start with you, and if you can let us know, what is your view in terms of what specific assets you think you're going to be bringing to market first? Is it going to be private market, public market assets, and what kind of led you to choose those to start with?
Yes, so I had a similar question on the panel a bit earlier, so apologies if it sounds like I'm repeating myself. But for us, it's all about this learning and evolving. So the first thing we'll be looking to bring to the market is our traditional offerings, so fund products in a tokenized form. And really, it's just because we want to understand how the mechanics work, get some proof statements out there, and then we can look at probably what everyone is excited about. And the real opportunity is tokenizing assets that are not necessarily as easily accessible currently in a tokenized form. But for us, we want to kind of walk before we start running.
And do you think that these assets, what jurisdictions are you planning to have them available on? Did you start thinking about that?
So for us, it's very important really that we're relevant within our home market. So the UK is a key priority for us. Given the proximity and our client base, Europe's another area that we're going to be actively involved in. That suits us in terms of our fund range, quite often sold into that base as well, so there's a familiarity. And then outside of that, Asia is the other key market that we'll be addressing, but proximity for us, although we've got a large presence there, means that it's sort of phase 2.
Thank you. And over to you, Ben. What is Wisdomtree bringing?
So you could summarize Wisdomtree's digital asset strategy in 2 ways. The first is to bring crypto assets in an institutional grade wrapper. We have a series of exchange-traded products that are passported across Europe and have been out for a number of years now. On the flip side, we're also trying to bring traditional assets on-chain. We just received SEC approval in the United States for a tokenized short-term treasury fund, WTSY, which is the first of its kind. 9 more are pending with the SEC right now. And then the Wisdomtree Prime Wallet is an application built on top of the Ethereum and the Stellar networks, where these tokenized products will be available direct to consumer. There's, of course, a lot more I could go into, but if that's a succinct summary for you folks.
Brilliant, brilliant. And Victor?
Yep, so a slightly different angle. We only have private markets assets, so we have more than 800 billion in assets under advice and assets under management solely on private markets. Now, for us, it's more on a purpose-driven, and I know this democratization is the biggest cliche, but if you look at what happened in 1990s, I think there are some relatively older generation in this room. You have to remember how much you had to pay to buy a stock back in 1990. That was at 8%. Everybody forgets about this 8%. Now, back then, an 8%, you had to pay a brokerage fee to buy a stock. And in 1990s, you had only less than 3% retail penetration rate in the public market. So that means 97% was institutional. So what has happened since 1990 to 2022? You've had, everybody praised Jack Vogel, Vanguard, because he democratized, right? Then you have Charles Schwab, Fidelity, you had eToro, and then Robinhood, and fast forward today, you have a zero-based commission fee. And then you have 27% approximately of direct holdings from retail, and you have 48% if you combine funds and ETFs, right? Now, if you look at back in 1990, how many stocks you had where you could invest, there were more than 9,500 stocks. Fast forward today, you have less than 3,500. Now, if you look at the retail or retail plus, be that ultra high net worth, or mass affluent, or mom and pop's 401k market, what are you left with, right? So, yes, now it's democratized, you can trade, but your universe had, 1/3, right? Before you used to have an Apple or Intel in where you could, make money post IPO. Today, that's a miracle, right? Let's go to Uber, for example, or the post trading, you plunge 20%, retail gets hit. So you're left with three choices, and not very attractive choices. First one being the meme stock. So you tell me, how do you digitize a GameStop a model when their mandate is to sell the games and consoles offline? That's impossible to digitize. So, but that was even value at a higher price than Twitter, and then retails end up getting hit. Number two is what Bloomberg quotes, and I didn't quote it. Bloomberg quoted as private equity for the poor. That's SPACs. So SPACs are private equity play, no track record, and hefty fees. So retail, again, gets hit there, 90% trading below value, 80% have not identified a company to acquire. And number three, you're left with cryptocurrency. So I'm not bashing cryptos. I think if you have conviction, you should do 5% like Betterment announced. I think that's a fair number. Fidelity wants 20. Good, but I don't think for retail you should put your entire net worth there. So for us, it's like, hey, if you don't have any other alternatives, what's the only holy grail left? And that's why I'm pro retail. I mean, real estate has already been democratized in a way with REITs, right? It has been done. You've had crowdfunding platforms allowing you to access private opportunities, but the magnitude that blockchain, like combining private markets, I think could be huge. Hence, going back to Hamilton Lane's mandate would be, hey, we would like to do something good. I mean, we're all doing this for the money, but this is the first time in your life you could do something really that has purpose. You can make money if you're adequately greedy. And that's what we're trying to do. We have done a tokenization pilot in Asia, 2 in the US, 3 more to come. One of them is on the Provenance blockchain. We're still trying to see how we could do it in Europe as well. So it's a purpose-driven, like the full democratization based on product distribution. Thank you.
Thank you. David, Invesco. Yeah,
thank you. So I think our focus is really threefold in digital assets, and so we've got some activity in the crypto space, and that we've already got some products, traditional exchange traded products that have crypto underlyings, and there's still some activity there, and we're exploring as an organization what it means for us to actually hold crypto and potentially offer that to our clients. But I think by far now the majority of the activity is very much focused on the digital transformation that's enabled by DLT, tokenization as a result of that, and our initial focus there at the moment is very much private markets. We've got a global real estate franchise which is about $80 billion, I think, something like that, and we. Not dissimilar to the gentleman to my right here, we did a proof of concept where we tokenized a small portion of one of our real estate funds 3 years ago. So the technology works. It's what do you do with that token at the outset? And we've seen a significant change in the market since then. So we see a significant opportunity bringing together the slightly disparate elements of our private market structure. It's kind of grown organically in different areas of the world. We haven't probably got the synergies of onboarding and processing and administration and organization that we can now kind of start to address through tokenizations. So we're kind of pretty actively exploring that space at the moment, and we think that's where there'll be significant advantages to be obtained in the short term.
So let's dig a little bit into that. So what are really the big advantages that you are looking for to gain within Invesco from the process of tokenization? Is it about efficiency? Is it about opening up new markets, more distribution, more access to investors, streamlining processes, going after new? I'm giving you a laundry list, but I'd rather hear from you. What do you think? Where's your thinking there? Is it efficiency-based or new markets?
I mean, I'm going to sound like a hollow echo for many of the conversations that have happened already today, because absolutely efficiency. One thing, there are, as many people have alluded to in earlier sessions today, significant friction in getting clients into products, the servicing and administration of those clients once they're there. And we see, significant opportunities through digitisation of achieving that. And then I think there's a whole slew of attendant benefits that will come as a result of the actual tokenization of the asset itself, and taking some of those processes that are undertaken today into a much more streamlined and an efficient manner. A lot of conversations about, bringing the other side of the transaction, the subscription, the fiat currency side of that, or whatever the form that currency takes. I think that the ability then to reduce settlement times and transaction times is something else that we see advantages in. But I think it's fair to say, we're a fairly large and fairly well-established organization, and we're taking I think what you might call a measured approach to this. So this is a step-by-step approach where initially we're going to be looking at some of our existing products, and sorry to paraphrase, I think Robert's comments of earlier, but we'll be probably looking at taking tokenizing some or producing a digital mirror of some of our existing products. And there's a big education journey that we need to take both our clients and also a lot of the constituents within Invesco through as well. So it will be a measured approach to this, I think.
That's interesting. I hear a lot from asset managers talk about the efficiency gain, and there's a lot of efficiency gain. And then what we do at Onera, we basically take the assets and we distribute them through the banks and other exchanges and so on. And what we see from them is they're also looking, well, there is some efficiency, but they're also looking at the potential additional revenues that are going to be generated by primary, secondary, borrowing and lending. That's a little bit in there. Do you think that the kind of flattening of the model to something that's digital, as Nadav showed before, to a single click of a button, do you think that that will change the business model in the market as well, where revenues are coming from, the sizes of commissions and so on? I think you started talking about this before, about how commissions change and structures change as market move to new technologies. Have you looked at that? Kind of, what is your thought?
I mean, for us, definitely. So we've had our clients that asked, hey, my clients are, so these are one of the top 5 banks, 2 of them. They're like, hey, why should I bank with you when I can go to this exchange and get the same product at a cheaper price with daily liquidity at a fractionalized cost? And some banks, they come and say, hey, I don't want your product being distributed to a B2C platform because we're losing our clientele, and this is disintermediation as well. But having said that, I mean, there's like, as of 2020, 68 trillion, excluding mom and pops, ultra high net worth, mass affluent of AUM, which is 48% of the entire market in that side. So you exclude the well-served ultra high net worth, which are the ones that can afford a bank account in Credit Suisse, UBS. The others are super underserved. You have the non-blockchain fintech like iCapital, Moonfair coming and servicing them, but still, I would say still well under 1%. I mean, Moonfair, with the tech that they have, they still were able to get 2 billion euros AUM. So there's a significant portion there. I think costs could come down, but there's like an absolute mass there in where I think could serve also an additional revenue if it all works with structuring and regulations.
Thank you. And I think on that front, your WisdomTree have a unique kind of approach because you're also launching a wallet, right? Can you tell us a little bit about that strategy?
Yeah, so the CEO of WisdomTree and founder, John O. Steinberg, about 20 years ago, realized that exchange-traded funds were going to disrupt mutual funds. And he built a very successful business over the last 2 decades with that disruptive business model. He sits here now and watches this distributed ledger or blockchain technology and says, that could do what I did to mutual funds 20 years ago, and I don't want to have that happen to me. So in essence, WisdomTree being a traditional asset manager, we of course have all of these ETPs and ETFs. We have a very strong core business there. But if you look at the WTSY, the tokenized short-term treasury fund, there is no fee on that. It's a zero-fee product. So the entire business model is changing along the lines that you just mentioned. No, you're not going to be asking for 8% anymore. We're going to have to find new ways in which to generate revenue. By the way, we can do that as well in a direct-to-consumer fashion. Again, very, very different to our institutional investor client base traditionally, but we'll be able to leverage that technology underlying it to enable us to do what we did before with an order of magnitude less people. So if we talk efficiency gains, I think the scale of the potential gains is worth noticing. And the nature of the change, you said disintermediation. Well, if everyone's standing up now for this game of musical chairs, and we say arbitrarily there's 10 chairs, 3 or 4 of them are going. And we're going to make sure that we're sitting down at least one of them, because structurally we think financial services are changing.
Do you think more asset managers are going to go in the same way, basically go straight to the target, bypassing distribution?
That's one way in which to do it, yes. In essence, doing a whole lot of roles that traditionally we might have outsourced to other parties or other people used to do for us, but we wrap it all up using this technology, as I said, with an order of magnitude less people.
Yes, I think that at Aberdeen, you had a slightly different approach. You invested in one of the exchanges here in the UK. So I guess you're also probably thinking about taking a portion of the profits of this new technology basically through an investment. Was that your model?
Yeah, that's one of the access routes that we thought we could help to monetize the disruption and the growth here, was to partner with partners that we felt had a valid use case if this was to be the success that we perceive it to be. So the kind of, just maybe getting back to the efficiencies question though, which is a really core and key component. And within an asset manager, you've got your CFO, who these efficiencies are really exciting. You've got your product team, and they're less concerned about efficiencies. They want something shiny and new and gets people excited. And it's that kind of where we are in some products. Efficiencies is going to be the element that drives the uptake. But there is also what is available here is product offerings that are just opening up access, democratizing access to investment opportunities that people wouldn't have access to. So I kind of think they are both very important aspects, but the operational side is one that fits much more on that efficiency savings, maybe as the CFO's lens would be prioritizing it, rather than maybe the manufacturing product lens.
Get it. And I think that this leads me to a next question that I wanted to ask as you were all talking. I think what's unique about you, the 4 of you, is that you basically represent the future, the digital world within organizations that may be a little bit, they're paid to be slow and risk averse and so on. Can you tell us a little bit about your challenges within an organization like that? How to drive a project like that, and what was good strategies for you to overcome that internal resistance? Well, as much as you can say without being embarrassed. Yeah.
I'm going to be really keen to hear everybody else's strategies, because managing stakeholders within an asset manager is the key kind of struggle you face. So whilst you can have support at a number of different levels, I think we mentioned earlier the FTX hit, sort of panic buttons being hit, and when that happens, and I don't know kind of what it was like within Invesco at the time, but what happens is all of that kind of funnels down to the single point, which is the touch point for it, and you just become the most sought after individual when answering what a pretty benign and mundane question. So the key skill to my mind is managing stakeholders, making sure that they understand the strategy, because it doesn't take much for them to be unnerved by the strategy. Sounds like your founder has got...
Ben, I think you have it easiest here, right?
Definitely. I mean, we have a board of directors that's very supportive. We have a C-suite that is completely behind the initiative. Maybe the hardest part is finding people who have got skills that you don't find in traditional asset managers. I may be one example of that. My background's in cybersecurity. Of course, cybersecurity is immensely important in the world of digital assets and cryptocurrencies. And we've built a team of roughly 30 people now, kind of people who will do front-end engineering, back-end engineering, cybersecurity, and so on. Very different set of skills, but the good news for us has been we've had a lot of support from the leadership of the organization.
How is it for you, Victor?
With me?
Yes.
So I'm sort of a one-man department, not a team. The biggest challenge is explaining what is blockchain and DLT. So I'm not, it doesn't come with age, but I think we all have to admit there's a stereotype. The older you get, the harder it is for you to trade things on app. The younger you are, the more likely is that that you would have, spend 80% of your day through the app. Hence, if you are in an organization where everybody is above 50, and they associate everything that is blockchain with crypto, you really have a long way to go. So I spend 50% of my time, like, walking them through why this is, safe.
Not crypto.
But then the toughest part was once you get a little bit more technical, and this is where, I would love to hear about the other colleagues, is the view when it comes to the CBDCs and, should we get a bit brave with stable coins? I mean, USDC never got depegged, but hence, hey, 3 years worth of history, but Luna Terra was the largest stable coin that disappeared. FTX happening, it doesn't help. I think that when that element comes in, it's very hard to have a counterparty to discuss and form a view whether, hey, should we do this or not? It's very hard to have a very good informed decision aggregating data, and it's not like in macro and currencies, you do have this counterparties and a lot of wisdom that comes with the age, but when it comes to like USDC, Tether, and Eurocoin, is this something that we should be a bit bold, or should we just go with on-ramp and off-ramp solutions? Should we isolate? Should we use the Coinbases as custody? I mean, FTX, we had plans to talk to them at some point. It's all gone well. I mean, we would have been, this brand has been built over more than 16 years. I mean, would have, gone busted in just a matter of days. So that's a challenge.
I think that the core of what we're doing at the GDF Group is helping and connecting everybody with everybody within the regulated financial institution. And I think that when we're talking about stable coins like Luna, I don't think they're part of our world at all. Maybe USDC is at the far end of this world because it's custodied on BNY Mellon. That's something you can trust, but not anything more exotic. But what we are interested in as an industry is bank kind of operated, big players, again, BNY Mellon, I said, but also the big banks, there's JP Coin and others, going into this and enabling it well before CBDCs will arrive, which who knows when it's going to be. So I think now we're having in this group, the session is the asset manager is coming, and I just had a thought that the next session should be the banks are coming, right? And we'll bring the 4 bankers here, and we'll say the exact opposite, where the asset managers want to come, but what can you offer in terms of the payment and settlement? And over to you, David. What do you find within, you have a team, right? You're part of a team. You're not just yourself.
Yeah, I mean, we have a global strategy and innovation team, not solely focused on digital assets and blockchain, but a good proportion of our efforts are there, and that's sort of 35 people globally. I think going back to the question, to some degree, it was the advent of COVID and then the kind of almost explosion of institutional interest around Bitcoin at that moment in time as a supposed hedge against inflation and so on. And what that did was, I think, just focus people's attention on this whole space. And then I think we were blessed with a period of time where we were able to educate the very senior members, from the CEO downwards. We gave everybody a kind of level set in terms of what we meant by digital assets. And I think we were able to draw the distinction between the crypto side, if you will, and then what for us is a much larger opportunity, which is this whole digital transformation that comes through DLT, tokenization, and so forth. So much as I think, some of the more recent events, with FTX being the most recent one, I think there was enough knowledge around the organization to recognize that was something on the other side of that fence, if you will, and So it hasn't challenged necessarily the work that we're trying to do in terms of how we're now approaching the tokenization aspects and the wider transformational opportunities I think we have with blockchain. But I mean, I think the other challenge that we do have is, everybody's got a P&L, everybody's got targets to meet, markets have been down, times are tough, budgets next year are looking challenging. So, from the top down, what is the right speed at which we should go? Now, my view, and I think they put me in the role there because I'm well over the 50-year thing, and so if I can understand it, everybody else in the organization can stand it. But what is the right level of commitment? Because I would have us going much faster, but I think, we're trying to balance keeping the lights on and keeping the business operating effectively versus, still investing in innovation and moving forward. So, and we continue to progress, probably not as quickly as I would like, but that's always going to be the case, I suspect.
Yeah, and it is an ecosystem, right? The fact that we're sitting here with a whole group of, people that work in regulated financial institutions and come from the right side of the fence, as you called it. The ecosystem itself has influence as well on the willingness of people to work with. If you work with big banks as distributors and they're willing to take your assets and distribute them, then it provides a lot more, I'd say, comfort internally for the ability to actually distribute them compared to if you were to put them on, I don't know, on FTX, for example, where nobody would be happy with that. And so I think that's in terms of leads me to the next question about distribution. Where would you like to see your assets once they're tokenized? Where would you like to see them distributed?
So I think
who would be your partners?
I think, we've had conversations. So we believe there's a role for us as someone that will create and issue tokens into some form of marketplace, but we're very conscious that a number of our strategic distribution and client partners are also building and creating these networks. So the whole kind of premise behind Onera and this interoperability, so we can create product, but that product can then be distributed across a multitude of different networks is we see that as an absolutely essential thing. Now that comes with a whole slew of challenges and so on that we'll need to address. But so I think we're trying to work out how best to position that. So we will have product in our own right, and we'll distribute through partners and clients as the model kind of develops.
Yeah, and I think you, Victor, you already work with an ecosystem because I think you tokenize in more than one place, right?
Yeah.
So you're kind of spreading your.
Yeah, so we've done it in 3 places. We're looking in Europe, but to your question, I think it could be anything because, and this is where it's mind-boggling, right? So in the States, you have a transfer agent that suddenly becomes a broker-dealer ATS, right? It's a trend, right, to acquire one and to have one. You could have a crypto exchange like a Gemini Galactics. They have a broker-dealer ATS. They could be distributing security tokens too because they have the license. It could be a bank, Singapore, DBS. That's a bank, but a bank is becoming a marketplace. How do you justify that? And then you have like LSE or SDX, or Deutsche Börse. They have their own exchanges. They could be also a marketplace. And you have securities house like SBI in Japan. The Koreans, now they have a friendly government. They've all filed licenses to become security token operators, and they are their own securities house. They were not meant to be a marketplace. So it could be anything because, and this is the beauty of this industry, you can do primary issue and secondary trading, be a registered investment advisor, be your own custodian and transfer agency, and this is maybe how you achieve price efficiency. And communication platforms, bridging platforms could also become the solution. So anything that can act as a channel, I think would be our choice. But it has to be safe, regulated, fiat-based for now.
Yeah, of course. You're tokenizing with Securrency, I believe?
It's one of our partners, yes.
It's one of your partners, okay. But I guess you're also looking to, I'm assuming that you will look to distribute globally. But can you actually at this point distribute globally, or are you more US-based, or what are the geographics that you're targeting, right?
For the moment, WisdomTree Prime's got an approval to across states in the United States of America. with a plan by this time next year to have started moving abroad with it. To get back to your question, where will the tokens be, or how will we distribute them? You've got like where you buy tokens right now. So that's your Coinbases of the world. That's through any number of apps. We'll have WisdomTree Prime. The kind of more interesting one, though, is like, where are you just seeing the tokens become available? Did you notice that Apple Pay added USDC today? Did you know that
what?
Apple Pay has added USDC functionality?
No,
Do you know you can accept Bitcoin payments on Twitter? So if you start to think a little bit, you realize that if it's open source software, you just plug it in inverted commas.
Yeah,
and
but for
suddenly,
securities, it's a bit more complicated. You need a broker-dealer.
yes, and we have those
Yeah,
licenses.
but Apple can be a broker-dealer like that. Okay,
Yes,
it's not a big deal.
correct.
Yeah,
Exactly.
I think that the way that I looked at it is digitization is going to create two battlegrounds. The first battleground is who is going to digitize the best assets, and that's where you compete to bring the best assets to the market, and the big banks compete and so on. But the second battleground is who's going to bring the best investors by giving them a digital wallet to invest. That's the war, okay? Now, the banks and the current players have some sort of an advantage. The new players like Archax also have an advantage. But the Coinbases of the world can just get a broker-dealer, the eToros and so on, Robinhood, and they know really quickly how to scale and how to push. So that's the war that's going to be fought. The battleground is going to be fought for the two sides of the digital revolution, if you will. And we were coming in on time, and I wanted to kind of try to get your kind of understanding of the timeline, or what you expect the timeline to be. Because I would put it this way. We started doing the GDF group about 2 years ago. It was a vision, right? It was a vision, and everybody were in the room thinking about it as a vision. Very few people were tokenizing things, very few asset managers around the table. The banks were kind of playing with it. And over the last 2 years, the vision was built to the point where we can sit here and the asset managers are coming, and every serious asset manager on the planet has a team and doing it. So it took 2 years to do that, but we're not yet in scale or anywhere near it. I do believe that in 10 years, right, everything will be digital. That's how digitization works. I mean, Spotify came in, and people don't buy vinyl records anymore. It's Spotify. What is your expectations in terms of timeline? What do you think will happen in the next few years? What can happen in a year? What can happen in 5 years? In 10 years?
Yeah, okay. So I think in a year there will be asset managers with tokenized offerings out there. In 3 years, the tokenized offerings will be maybe pushing the envelope of what it is that people would expect tokenization to be able to provide you access to. The question of will it be retail that's buying these private assets? Regulatory is going to be the driver of that, and as a body, we can kind of press for that to happen. To me, that's the game changer. The one thing I'm probably most nervous about, though, is liquidity. So for this to work, you need to have things trading at pretty tight spreads and not to be just bilateral. So, in 3 years, will everything be there trading at tight spreads because there's liquidity, market-making infrastructure to allow that to happen? I'm not going to go on the record for that one.
Got it. Yeah, no, I think that on at least some private markets, today the average trade is 1% a year, the secondary, because it's extremely hard to sell. You can only sell after a few years. You just have to sell the whole thing. Nadav spoke about it earlier. Just going from 1% to 5%, even if you don't go to full scale, high frequency trading, it's still 5 times on markets that are today in the tens of billions of dollars of trade every year. So but I agree with you that until we get much wider distribution, right, we can't get the liquidity that we want. That's why interoperability is so important.
I think if I was a regulator, I'd be wanting to get comfort that the retail investors that are owning something they wouldn't have have the ability to be able to get out at a reasonable NAV, and that it's not going to be kind of liquidity that means that there's a significant risk that they take at that point.
Ben, 1, 3, and 5 years, or when do you think WisdomTree is going to be wholly tokenized?
Well, we've got this pet theory that this kind of crypto digital asset infrastructure and traditional finance are merging to a point where it's at some point down the line, a little bit like people used to use the term e-commerce. E-commerce, it's just Amazon, it's just buying stuff now. We think it's a 5 to 10 year time span. The most important thing though is along the journey, you can't rush it. FTX has been a very sad example once again of where a lack of professionalism in the digital asset space has led to investors being hurt again. So making sure that things are transparent, correctly structured, and have full regulatory approval is paramount. And so if there's anything that slows it down, it's just making sure that we do things correctly. Because if once you break that trust, it's game over.
Victor, you're 1, 3, and 5 years.
Yep, so coming to age, the silver lining of the FTX event was that victory to the more matured. So if you look at all of the press releases, articles about the FTX, they highlight for the first time Sam Bankman-Fried's age of 30 or 33. And second most quoted one is the CEO of Alameda Research, the lady with 23-year-old, and this has never been highlighted before. So to the point earlier, I think, yes, not trying to rush it. I mean, we've always been wrong in this industry when it comes to digitization, so can't really predict, but we just see it as democratization 1.0 is serving the underserved and the accredited space, so no need to fight with the regulators. 2.0 would be really going through the mom and pops, and there again, I agree with the comments on the regulators making a big difference, but we already see Department of Labor in the States issuing information letters, quoting 60-40 doesn't work. There needs to be a bit of more like private markets. So there's a trend that is going there, so who knows, that may change soon. And 3.0, and this is my personal view, is a re-democratization for institutions. Now institutions, they see the benefits, they see that, you know, the retails and they're all trading, hey, now time to go in. And you know, from the efficiency, cost, transparency, maybe they want to, you know, go in and ask all of their GPs, hey, I want my stake. Hey, Blackstone, give me my 500 million on tokenized format, right? And again, the secondary transaction, everything would flourish, but God knows how long that would take.
David, your final.
Yeah, I think it was Bill Gates that said that we all massively overestimate the amount of change that will happen in the next year and dramatically underestimate what happens it was either 5 or 10, I can't remember. But I think, you know, in terms of predictions are a dangerous thing, but certainly there'll be some form of tokenized offerings, I think, starting to roll out from the kind of asset managers as we've described in the next year, 18 months and so on. I think one of the areas that's going to be really interesting from the retail space is all of the people, you know, Coinbase have 110 million clients or whatever the number is, some astronomical number. You know, but they're all holding crypto with Coinbase at the moment. When they maybe get an appetite and they want to diversify and have access to different investment classes and so on through a regulated structure, and they want to do that in the same format and medium that they've already been exposed to, there's a massive opportunity there in terms of how, you know, how that particular segment might grow. And it's probably not a segment that we as Invesco are particularly serving at the moment, because, you know, they're predominantly younger, not necessarily coming through the traditional channels that we distribute our products through today. But yeah, I think the availability of regulated, you know, acceptable exchange locations, you know, we've heard from some already, but the more of those that come online and become available makes the whole kind of increase potentially in liquidity and secondary trading much more available, and I think that then helps spur the market on. But I don't know when we get to that kind of fully tokenized or fully digitized nirvana. It's yeah, at some point.
You know, I think kind of as a summary comment, we talked about FTX, which was, you know, non-regulated, happening in the Bahamas, and maybe because the regulation wasn't clear enough for crypto to operate in a place where it could be actually regulated. So it was pushed out in there, and there it exploded, bad actors and so on. We're completely different. But if you look at the entire crypto market, is today less than $1 trillion market. Four of you today represent what? Probably 6x, 7x more than or more than just the four of you, than the entire crypto market. So this is the real market, and I think that when we're building this market, there's you know, people call it chicken and egg. You need to have the assets And if you have the assets, you have the distribution. And if you have distribution, you have more assets. And if you have more assets, you have more distributions. So I'm really glad to see that the assets are here. And as I said, our next kind of session will be to bring the distribution and say the distribution is here as well. And my prediction is that 23 is the build year, if you will, where we're going to start to deploy all of these assets, some of them in POC forms, and then some of them in more real form, and then more and more and more through the year. And the better quality assets will come, more distribution will come, the big banks will distribute, and I think 24 will be the exponential year. And when these things go exponential, you can't predict how fast it will go. And the market is so big that whatever happens in 24 is going to be much bigger than crypto, to the point that it will dwarf it. But that's my view, obviously. I want to thank you all for coming today. We have some people still on the Zoom. Anthony, you want to say a few words to wrap up? Thank you very much, everyone. Thank you.
Thank you.